Welcome to Subramani. Let us look at some simple steps for investing and simple rules for investing. You have decided at last that you will start investing, and you are not too keen to invest only in mutual funds. You also want to buy direct equity, and for investing in direct equities, you have no clue how to go about doing it. For example, your broker tells you to buy something and you buy it. Unfortunately or fortunately, every broking company, whether it is the big ones, the banking ones, etc., will give you a relationship manager whose main job is to ensure that you do something by which the brokerage company's income goes up. So he will give you a tip a minute, if not a tip a second. And you'll say, sir, ye le lo, iska itna stop loss hai, you will make so much money. And there's a very, very good chance that initially 1 or 2 deals you will even make money. But overall, his job is to churn your portfolio enough number of times to justify his salary, right? So staying away from the relationship manager is a very important thing in if you're serious about your broking life, or rather about your investing life, right? So stay away, listen to him patiently, nicely, politely, but don't do whatever he says, or do quantities which are much smaller than what he expects you to do. Because if he expects you, if suppose you have a 3-4 crore portfolio, he would expect you to do at least 5-6 crores worth of trade in a year, right? Now reduce it to 30 lakhs. Suppose your portfolio is 10 lakhs or 30 lakhs or whatever. For him to make the same amount of money, he will have to churn you much more often. So that he will do. Then he will suggest IPOs, NFOs, again where he makes more money if you invest. So he would suggest those things. That is completely up to you how you react to that. But largely staying away and not listening to him is a very good first step. What are the other things you should do? First of all, you should know in the company in which you are investing what the company does. So simple companies are easier to understand. Colgate is easy to understand. They make Colgate toothpaste. You have used Colgate toothpaste and it's easy to understand. And you also have to understand this company is doing nothing new. It has got nothing exciting, no new products for a very long time. Even in oral care, they've given up market share to some people, but you at least understand the business. Or Gillette is in the shaving blade business, and that's the only thing which they do, which means they take care of the unwanted hair in your body. So tomorrow they could come out with a clipper or things like that, but yes, largely you understand the business which they are doing. But it's very difficult to understand what business Biocon is doing, or Dr. Reddy Laboratories is doing, or Infosys is doing. It's far more difficult to understand. So you need to read about it, and at least by knowing what they are doing, you can then ask simple questions. 5 years later, will the world need their services? Will people continue to use shampoo, toothpaste and razor blades after 5 years? Right now it looks perfectly possible, and it is bound to be there. Yes, there could be somebody who would come and disrupt and give at lower prices. Those kind of things could happen. But largely, I don't think people will change their toothpaste or shaving blade as easily as the new guy who's come to interrupt wants. Yes, he could come, he could make some noise, but yeah, these are 2-3 things. One is understand what the company is doing. Make sure that the company will be doing this after 4-5 years when people still need it. Does the company have any low-cost competitive advantage? Largely low-cost competitive advantage today has meant the power of the brand. You have no clue how much a little bit of plastic and how much a little bit of steel costs, but when it becomes a Gillette razor, it commands a price, right? A simple shave once and throw product also from Gillette makes money for Gillette. Otherwise, it's got more sophisticated 3 blades and things like that. I do not know whether it's come out with 4 blades, but yeah, 3 blades. When we shifted from single blade to sandwich blade, we did it, and then we shifted. So we are like addicts, keep going back to it. See whether the company has a product which is really addictive. Look at ITC. It will always make money for the shareholders if it gets its asset allocation or the cash allocation right. And also let me warn you, any example that I'm giving you in this is just for an just as an academic reason. I have Gillette, I have Procter and Gamble, but I will not hold ITC anymore. I used to hold it long ago. So find out what the company does, whether the clients will need it after 3 years, 5 years, right? That's important. Is the company almost recession proof? You cannot get all companies which are recession proof, and some companies which are actually doing very well may not get reflected in the market for a long period of time. Cummins used to have a very huge price fluctuation. Recently only it has broken out of 500. Siemens, for example, it's not a company which people speak about when they speak about FMCG and things like that. Those are the companies which are spoken about. But this is again an MNC, low floating stock, and all those things are there. You understand what business they are doing, very difficult. But you could go and read and realize one thing, that Cummins and Siemens, like Ingersoll Rand, etc., are in the infrastructure business. So as and when the infra business does well, they will do well, but at least you understand what they are doing. Is the company growing consistently? Is the company increasing dividends consistently? Is it good management? I define good management very simple. Do they leave enough meat on the table for the others to eat, or do they eat everything, right? Look at a lion. It kills, it eats 20%, 25%, and then leaves it to the smaller animals, the jackals and the hyenas of the world, right? So does the management create enough wealth, and does it take little bit and leaving enough for you on the table? Does it have a low payout? Does it have a 30-40% payout, or is the payout already at 80-90%? When the payout is high, it means two things. One, company does not have adequate cash flow to service the equity, but they know that if they don't pay out huge dividends, there will be selling pressure. Therefore, they are paying dividends almost under duress, right? So find out if it is a low PE, if it's a low PE stock and it has got a low payout, it's a good thing. But having said all this, even giving the examples which I gave you, none of them will ever be available cheap. They are always expensive. You may have to decide whether to buy or no based on some other things, but prices won't drop just because you want to buy those shares, right? Does the company have low debt? I don't like companies with too much debt, but this is at a time in life when interest rates are at their historical lows. So even if a company has some debt, it could be strategically because they have invested that money somewhere where they think they will get a yield better than that, and that is perfectly possible today because interest rates have fallen dramatically for good quality corporates. Does the company have a good rating? Does the company do a buyback, or does the company pay out a huge dividend? Good chances, thanks to the change in the tax laws, good chances that more and more companies will go and reward by the buyback route rather than by the dividend route. Take TCS, take Wipro, both are coming out with buyback and not just giving a bigger dividend, right? Does the company, how often does the company buy back the share? And most MNCs don't, because they already have a very low floating stock. If Colgate were to do a decent size buyback, the whole shareholding pattern will get impacted, and then floating stock will fall. So many of these companies have to actually do an IPO, or rather a follow-up public offer, rather than buy back the shares. So that is the problem you will have with MNCs, right? Keep your emotions out of investing. When you're investing, invest. It is very difficult. It takes us very long periods of time to believe that we have controlled our emotions, and then we go and do some absolutely stupid mistake because of emotion. Then you realize, oh, I have not been able to get rid of my emotion. So keep calm. Make sure that you learn your meditations, develop your meditative skills. All this will help. And like John Templeton says, start with a prayer. That's very important. Thank you.